Welcome back to the Muni Credit Cast from Build America Mutual. I'm Mike Stanton, Head of Strategy and Communications here at BAM, joined by our Chief Credit Officer, Suzanne Finnegan. Thanks again for being here.
Happy to join you.
The Muni Credit Cast is our monthly opportunity to talk about the questions investors can be asking about the credit quality of their municipal bond portfolios. Welcome to Episode 2, looking at hospitals and healthcare. Suzanne, one of the things new investors might not appreciate about the muni market is the diversity across sectors. And today we're going to focus on the diversity within one of those sectors, healthcare. More specifically, we're going to be talking about not-for-profit hospitals and hospital systems. This seems like it's a topic that's perfect for our catchphrase. If you've seen one muni bond, you've seen one muni bond.
That's right, Mike. Healthcare stands out from other sectors in the muni market in several different ways. First, there are relatively few issuers, but every one of them is unique. And the credit quality of hospitals and hospital systems is more reliant on the operating decisions made by their leadership teams. National issues also come into play more often because a large part of all hospitals' revenues come from national programs like Medicare and Medicaid, and even the private insurance payers are heavily impacted by state and local regulations.
So how does that impact your approach to healthcare credits?
Well, as always, it starts with the analysis of a specific issuer. We look at all of the obvious topics, things like operating performance, the size and economic health of the service area, and a given system's market share. But we also have to assume that there will be volatility in all of those areas over the life of an insured bond deal. So you also have to look at the system's balance sheet and its ability to adjust to changing conditions.
And that's exactly what our guests are talking about in our featured interview. We're joined by Martin Arrick, BAM's Head of Healthcare, and Gia Calabrese, Vice President and Healthcare Specialist in our Public Finance Group. Martin, Gia, and our colleague Rebecca Sullivan recently wrote a column for The Bond Buyer where they talked about the fact that the industry is really at a turning point. Dealing with COVID was a major challenge, and some systems handled it better than others. But for a credit analyst, that's really yesterday's news.
Right. In a sector that's volatile, you always have to be looking forward. Martin, in particular, has been doing that for decades, and he and Gia share a lot of the questions they are asking when they look at hospital credits for BAM's portfolio. We've insured about 50 different hospitals and hospital systems nationwide, so we have a good perspective on the challenges facing the industry nationwide and on some of the best practices that are emerging to deal with those challenges.
And Martin is the former head of healthcare at S&P Ratings, so he also brings some real credibility on how those issues can impact bond ratings over time, and that in turn can have a direct impact on investor portfolios. Let's go ahead and hear from Martin and Gia. I am Mike Stanton, back here with Martin Arrick, BAM's Head of Healthcare, and Gia Calabrese, in BAM's Vice President in BAM's Healthcare Underwriting Group. Thank you for taking some time today. You are the two of the three co-authors of a recent article in The Bond Buyer looking at trends in the healthcare market, some of the increased issuance that we've seen year to date, and some of the continuing credit challenges. And this is an opportunity to talk a little bit more in depth about some of the things you raised in that article. So thanks for taking some time today.
Thanks Mike. For having us.
So, Gia, I'd like to start with you. One of the reasons that article was so timely right now, as I mentioned, is the fact there has been this major increase in bond issuance this year compared to 2023 and even 2022. What's driving that? What in the transactions you're looking at, why are they coming to market now?
Yeah, I think most of it is that things have finally started to stabilize for a lot of hospitals and health systems. You had a major disruption from the pandemic initially, and then that was followed up by significant labor and inflationary challenges, as well as really volatile investment markets that led to one of the worst years in the sector's history. While lingering impacts of these issues definitely still exist, I think hospitals and health systems are starting to adapt to the current environment, and investor demand has mostly returned for certain healthcare bonds.
So, Gia, what are those transactions? What's the money going for? Is this new projects? Is it maintaining existing infrastructure? How's the money being used?
I think a lot of hospitals and health systems are finally comfortable pursuing their capital plans. So definitely some of that new money, but also some refinancings from prior bond issuances.
So, Martin, let's kind of transition over to you. As you take a look, and Gia raised the issue that the last few years have been very challenging for hospitals. As somebody who has not lived his whole career in the healthcare market, I would say, it seems like a pandemic should be a great time for hospitals. There are a lot of patients. There's a lot of need. Why wasn't that necessarily the case here? And more importantly, what are some of the challenges that hospital managers had to face, and how did that translate to credit concerns?
Well, I think you're right. In some ways, a pandemic feels like it ought to have been a good time for the sector. There's real need. People were desperate to get into hospitals, obviously, if you had COVID. And at the same time, the federal government really stepped in with a lot of support because there's an underlying strength in the sector that was readily apparent. But at the same time, because COVID was so threatening at the time, people didn't want to go to the hospital. So all the elective surgeries, all the kinds of healthcare needs that might have been pushed off, in fact, were pushed off. So at the end of the day, it really wasn't a wonderful time for hospitals. And at the same time, you experienced staff burnout, for lack of a better term. So many of the healthcare professionals were facing incredible kind of psychological and physical pressures that they just burnt out. So that was a real problem. But I think as the sector emerged from the pandemic, there were a number of issues. One, we saw a host of supply chain issues, really across the economy, certainly in the healthcare sector. Personnel issues were huge. I mentioned the burnout. Lots of people decided it was a good time to retire or just really stop working full time. And a lot of hospitals literally couldn't get enough staff, had to use temporary agency staff, which is much more expensive. All of these things came together to create real difficulties, financial difficulties in the sector. And last year, you had very weak investment markets. So that was kind of a bit of a double whammy that hit the sector.
So those are all great points. Just really underscores these are complicated businesses that have to be operated by managers, and that's an important part of the analysis. Martin, before I just want to ask another question. You've got a deep background in the industry. One of the things you mentioned in the article was this was, you believe, kind of the most challenging credit period since 1996-97. Is that a good way to phrase it? And can you talk a little bit about what hospitals are experiencing then versus what they're seeing now?
It absolutely one of the worst periods since the middle 90s. At that point, there was a federal Balanced Budget Act, which created reductions to Medicare funding, but the reductions were much greater than anybody anticipated. And hospitals, their operating performance at the time really plummeted. And what was interesting, and something which I think we'll talk about in a second, is many institutions needed a few years to recover from that operating deficit at the time. So you have something that's sort of a little bit asymmetrical. sometimes the bad news happens right away and it really causes dramatic declines in performance. And then as management begins to kind of craft correction plans to rectify that, those correction plans often take a few years to really become fully implemented.
So Gia, let's go back to you and maybe ask you to pull back the curtain a little bit on what you're doing. You're looking at hospital balance sheets, financial reports, official statements every day. What are you looking at? How did these issues, these kind of management issues, show up in the financial statements? What are the indicators that you looked at?
Yeah, I think with regards to labor and inflation, you're first going to start to see substantial increases in salaries and benefits, supply expenses year over year that just aren't outpaced by revenue growth, especially if revenue growth was hindered by lower volumes, which we saw at a lot of hospitals and health systems. That's, of course, going to trickle down to your operating income. And then if your investments didn't do so well, which Martin mentioned happened to a lot of entities, you're not going to have sufficient non-operating income to generate good EBITDA margins that can cover your debt service obligations. And all of what I just mentioned is, coming from an income statement. But if a hospital or system isn't profitable in a certain year, doesn't have debt service coverage, that's when you're going to start to see cash decline. And if this is a trend that continues, you could see material balance sheet deterioration that really constrains financial flexibility.
And are any of those early warning signs? Is there something you see, like a ratio or a financial sort of leverage that changes, and you say, this is going to spill over to other factors?
I think you could say that for any of the metrics I just mentioned, but it's kind of really about identifying a trend, I think. And I'm sure we'll touch on this later, but there are definitely certain credit characteristics of hospitals or health systems that we feel like help outweigh some of those financial challenges and help support them through periods of financial stress. So it's really, if we see a trend, that's when we'll start to get concerned and feel like there have been red flags that could trickle down to other metrics.
Yeah, that's a great point. So again, the longer term perspective is important.
Yeah.
Martin, so turning the page to the second half of your article, you talked about as hospitals do get back to kind of a period of normalcy, there are these kind of long term challenges for the healthcare sector that are reasserting themselves on the landscape. Can you walk us through some of those?
Sure. So we've talked a little bit about the short-term issues, but some issues are really have been around for a long time, and they're not going away. Let's talk about long-term workforce challenges. If you look at population growth, the number of physicians, the number of nurses that are projected to be needed in 10 to 15 years are much larger than the current supply and the projected supply. So those are issues where the solution is a little less clear. More money for higher salaries, obviously a near-term fix, but over time we're going to have to go to how do we both bring in more nurses, train more doctors, and that's happening, but it's slow. Some other issues are declining utilization rates. As the practice of medicine itself has improved over time, more and more things can be treated on an outpatient basis, can be treated with new drugs, new pharma solutions. That's all good for the patient, but declining use rates push patients out of the hospital. And frankly, there's been a bit of a flight to quality, so that if you do end up needing hospitalization, you probably maybe are more likely than in the past to end up at a tertiary facility. So there's a bunch of issues around utilization, but the movement to greater outpatient settings has also changed the dynamic around competition. There are many more competitors than there used to be, whether it's surgery centers, physician-owned practices that can do more big retail drugstores, other kinds of venues that want to get into the outpatient business. All of this is driving to sort of take little pieces of the healthcare pie out of the traditional hospitals and health services. Having
And that's
said that, hospital and health service systems are in fact doing more outpatient business than ever before, and that's good. But competition itself is going up. You know, one of the others that I have my eye on is just the aging of the population. And that's very slow. But if you really take a look, you have more and more people qualifying for Medicare. Usually, those people are giving up commercial insurance to, as they age into Medicare. That generally has a small, each patient has a small financial impact on hospitals because Medicare is not as good a reimbursement as commercial. To some extent, offsetting that is the strength of the economy, new jobs getting created. Companies are having to recruit people, working a little harder to recruit. Part of that is maintaining benefit structures for employees. We see where that will go over time, but we are seeing payer mix deterioration. So those are just a few of sort of the long-term issues that we're seeing and have our eye on.
And so, just to raise one thing, historically, hospitals might have turned to merger and acquisition activity to make themselves more efficient, cut their costs by doing some consolidation, maybe in the back office. That also obviously has an impact on the competitive front. Should we expect to see more of that?
Well, I think we will. I think, as you point out, the reasons why consolidation happens, those reasons still exist, and I think they're still driving consolidation. At the same time, we're seeing the federal government, FTC, DOJ, and state attorney generals working a little harder to slow M&A. They're raising more objections. So those two trends are somewhat offsetting. But I do think the underlying needs within the industry to get a little bit bigger to help control costs will, at the end of the day, keep driving continued M&A activity.
Great. So, Gia, let's just one more question before we wrap up today. Let's end on a positive note. So, what are some of those strong credit factors you mentioned? There are things that you look at that makes systems stand out. What are some of those?
Yeah, as we've discussed, a strong financial profile is obviously a credit positive that we consider. But ultimately, I think what we're really looking for is some level of essentiality in a service area such that a hospital or a health system has staying power in their market for the long haul. A strong enterprise profile, which is driven by things like market share, strength of service area, revenue and geographic diversity, breadth and depth of service offerings, utilization. I can name a million things there, is really what can support hospitals and health systems during periods of financial distress.
Great, and a really interesting tie in there that those are managerial factors that you can quantify. That you can turn into indicators for comparison head to head. So it's an interesting look into your analysis. Well, thanks for both of you taking the time today, and this is a great discussion. Have a great afternoon.
Thanks, Mike.
Thank you.
Thanks for listening, and thanks again to Suzanne Finnegan, Martin Arrick, and Gia Calabrese for joining me for today's episode of the Muni Credit Cast from Build America Mutual. We'll be posting a new episode every month, so subscribe wherever you get your podcasts. Build America Mutual is rated AA with a stable outlook by S&P Global Ratings, and we insure more than $100 billion of municipal bonds from across the U.S. For more information, visit www.buildamerica.com or email us at creditinsights@buildamerica.com.